The United States government now spends more money servicing its debt than funding its entire military. That is not a forecast. That is the fiscal year 2024 accounting. $1.1 trillion in interest payments, $886 billion in defense spending. Interest 1. Ray Dalio has been warning about this exact threshold for years, not the general environment, this specific marker. Because in more than 5 decades of studying how empires have collapsed, Dalio identified the single clear signal that separates a nation under financial stress from one entering structural decline, and that signal is interest payments overtaking defense spending. That marker just appeared in the world's largest economy, in the country whose currency is almost certainly sitting in your savings account right now. But here is what you need to understand. This video is not about one country, it is about 7, and the thumbnail you just clicked is built on something real. The IMF is currently monitoring 7 sovereign debt situations simultaneously. 7 nations showing the same deteriorating pattern across 3 specific indicators that, in 300 years of documented financial history, have never once appeared together without a formal debt crisis following within 18 months. Not one single exception in 3 centuries of documented history. Not one. 3 of those 7 countries are not in the developing world. 1 carries a debt-to-GDP ratio of 263%, the highest of any developed economy ever recorded. 1 destroyed 4 decades of monetary credibility in under 2 years through a single act of political interference with its own central bank. And the country sitting at number 1 on this countdown, the one in that top position on the thumbnail you clicked, is the country whose dollar is almost certainly sitting in your bank account right now. Most people watching this assume the story is about somewhere else. Pakistan, Bangladesh, Argentina. Nations that feel distant from your mortgage payment, your grocery bill, your retirement balance. That assumption is wrong, and I am going to correct it right now, because if you carry it through the next 30 minutes uncorrected, you will miss the most important part of what this data is showing. The pattern Dalio mapped across 500 years of financial history does not negotiate with reserve currency status. It does not care about military power or geopolitical prestige. It responds to one input, the math. And in April 2026, across 7 economies simultaneously, that math is speaking. We are going to run every one of these countries through the framework: debt cycle position, reserve coverage, and the precise indicator that locks each one onto the collapse timeline. By the time we reach number 1, you will understand something the financial media refuses to say out loud. The country that falls first does not just collapse on its own, it pulls the entire system down with it. Stay with me here, because this next part changes everything. If you are finding this useful, subscribe to the Reid Briefing. I publish this analysis every single week. In 1944, the British Empire sat across the table from American negotiators in New Hampshire and handed them the keys to the global monetary system. That agreement, Bretton Woods, was not a diplomatic formality. It was a funeral. Britain arrived with record debt, a currency it could no longer defend, and an economy sustained by American loans it had no realistic plan to repay. The empire did not collapse at Bretton Woods. The collapse had already happened. The conference just made it official. Ray Dalio's economic machine explains exactly why. If you understand the mechanism, what is happening across 7 economies right now stops looking like chaos. It becomes a pattern you have seen before. Here is how the machine works. Every economy runs on credit. Credit expands, activity rises, debt accumulates. Over decades, debt compounds faster than income grows. Dalio calls this the long-term debt cycle, a 50 to 75-year arc from expansion to saturation to forced deleveraging. The saturation point always shows the same 3 warning signs before the system corrects. Warning sign 1, debt to GDP crosses 90%. Rogoff's research across 66 countries and 8 centuries found that above this threshold, median growth falls by roughly 1 percentage point per year, and the probability of a debt crisis increases by 400%. The runway has shortened dramatically. Warning sign 2, foreign exchange reserves fall below 3 months of import coverage. Below this threshold, a country cannot defend its currency against speculative attack. The IMF formally classifies this as reserve distress. The government begins making choices it cannot say publicly, whether to service its debt or import food. Warning sign 3, political leadership abandons monetary orthodoxy. This is the irreversible signal. Dalio has tracked it across every major modern collapse. When the dual pressure of creditors demanding austerity and citizens demanding relief becomes unbearable, governments print money to resolve a debt problem. Rational in the short term, catastrophic in the medium term. When all three signals appear simultaneously, researchers call it the triple coincidence. In 30 years of cross-country analysis, every nation that hit all three experienced a formal default, a restructuring, or a currency collapse within 18 months. Not one exception. Dalio's framework places the United States in stage 5 of the long-term debt cycle, the stage where interest costs constrain the entire fiscal system. Not a projection, a current classification, confirmed by current data. Stage 5 is where the British Empire stood in 1947. It is where the United States stands in April 2026. Here is the question I want you to hold for the next 20 minutes. Of the 7 countries on this countdown, how many have already crossed all 3 thresholds simultaneously? The answer is the part nobody in mainstream financial media is putting on screen. If this framework is making sense, give this video a like. It genuinely helps this analysis reach more people who need to see it. Stay with me, because the next section is where the historical record gets uncomfortable. The British Empire did not collapse because it was weak. It collapsed because it followed the same sequence every dominant empire before it had followed, stage by stage, decade by decade, until the mathematics made the outcome inevitable. Here is that sequence. Pay close attention, because you are going to recognize it. Stage 1, genuine dominance. Britain built its supremacy on the Industrial Revolution, naval control of global trade routes, and a currency the world trusted. The pound sterling was the global reserve. The world ran on British financial rails. Stage 2, overextension through conflict. World War I cost Britain approximately 136% of its GDP, funded not through taxation but through debt, foreign bonds, American loans. Britain entered 1918 as the world's largest creditor nation. It exited as a net debtor. Stage 3, the debt trap. Through the 1920s and 1930s, Britain spent a rising share of its national budget servicing war debt. Interest payments competed with defense spending. The empire still functioned on the surface, while beneath, the debt cycle was quietly dismantling the foundation. Stage 4, the quiet reserve challenge. By the late 1930s, the dollar was displacing the pound in international settlements. Foreign central banks diversified their reserves without announcement. The shift happened transaction by transaction, institution by institution, and most people did not notice until it was already done. Stage 5, the forcing event. Suez, 1956. Britain intervened militarily in Egypt after Nasser nationalized the canal. The United States, now the dominant creditor, threatened to sell its sterling reserves on the open market. The threat alone was enough. Britain withdrew within days. The most powerful empire in modern history retreated because it could not afford the currency consequences of staying. But this is where the pattern gets uncomfortable. Suez was not the beginning of Britain's decline. It was the public confirmation of a decline that had been mathematically underway for 30 years. By the time the world saw the empire retreat, it was already over. The fall was not an event. It was a sequence. Now map that sequence onto the United States in April 2026. Stage 1, post-war dominance, Bretton Woods, dollar reserve status. Stage 2, Vietnam, Cold War overextension, debt accumulation. Stage 3, compounding deficits across 5 decades. Stage 4, central banks globally cutting dollar reserve holdings, now at their lowest share since 1994. Stage 5, interest payments exceeding defense spending, confirmed fiscal year 2024. Every stage, in sequence, on schedule. The United States is not approaching the British Empire's pattern. It is inside it. The question is not whether the sequence is running. The question is how far along it is, and what that means for the people living inside the system while it moves. And here is what happened to ordinary British citizens at exactly this stage, which is what we need to talk about next. Give this video a like if the parallel is landing. 2 seconds, and it helps this analysis reach more people who need to see it. Here is the current signal. And it did not arrive gradually, it arrived in a single week in April 2026 that most people completely missed. Gold crossed $4,000 per ounce for the first time in recorded history, not because of a war, not because of a single crisis event, because central banks across 14 countries simultaneously increased gold purchases while cutting U.S. Treasury holdings. In the third quarter of 2025, global central bank gold demand hit 1,313 tons, the highest quarterly figure on record. That was not speculation. That was sovereign-level institutional repositioning. Here is what the data is actually showing us. China has cut its treasury holdings to $730 billion, the lowest level since December 2008. Japan holds $1.15 trillion, but Japanese institutions now face domestic pressure to repatriate capital as the Bank of Japan normalizes interest rates after decades at zero. The two largest foreign holders of U.S. debt are both moving in the same direction, reducing, quietly, without press conferences. Meanwhile, the U.S. Treasury is managing what analysts now call the maturity wall. In fiscal year 2025, $9.2 trillion, roughly 25% of the entire national debt, matured and required refinancing in a single year. Treasury Secretary Bessent confirmed that long-term debt issuance was no longer economically rational. The government is rolling everything short-term, at elevated interest rates, into a market where the largest foreign buyers are reducing their positions. The Federal Reserve ended quantitative tightening in December 2025, maintaining its balance sheet near $6.5 trillion. Dalio named that move precisely. He wrote publicly that this was not stimulus into a depression, it was stimulus into a bubble, the exact late-cycle dynamic he has tracked across centuries of financial history. It is managing the liquidity needs of a debt structure that cannot survive without continuous central bank support. Now look at what the institutional money is doing. BlackRock increased gold ETF inflows by 34% in the first quarter of 2026. JP Morgan flagged U.S. fiscal sustainability as its primary macro risk in research notes published in February 2026. Jamie Dimon referenced the debt trajectory in 3 consecutive quarterly earnings calls. When the CEO of America's largest bank mentions sovereign debt risk 3 quarters running, that is not boilerplate caution. That is a signal. Most people are completely missing this. They are watching nominal stock prices. Goldman Sachs is projecting just 3% annual real returns from U.S. equities over the next decade, and that projection assumes no sovereign debt event in the intervening period. Goldman is telling its clients that nominal gains are masking real purchasing power erosion. That is not a bull market description. That is a slow-motion wealth transfer from savers to debt service, framed carefully enough to avoid a public reaction. And this is where it stops being an economics lecture. The institutions have repositioned. The central banks have repositioned. The question is whether you have the framework to understand what they are signaling and why they moved before saying anything publicly. Here is what the decision makers are actually thinking, and why it matters more than anything you have heard so far. The surface story is that the United States has a debt problem. That is true. But the real story is which of 3 available exits the government has already chosen without announcing it publicly. There are only 3 exits from Stage 5. Option 1, austerity. Cut spending, raise taxes, reduce the deficit. Mathematically correct. Politically impossible. No administration has achieved meaningful deficit reduction in a high-debt environment without triggering a recession that collapses the tax base further. Option 2, formal default. Stop paying or renegotiate. This destroys the dollar's reserve currency status immediately, the structural advantage separating the US from every other country on this countdown. Not a realistic option. Option 3, controlled currency debasement. Print money to service debt. Allow inflation to erode the real value of outstanding obligations. Never call it a default. Let purchasing power decline steadily until the debt burden becomes manageable in real terms. This is what Dalio calls the ugly deleveraging. A beautiful deleveraging requires 4 simultaneous conditions: debt restructuring, meaningful austerity, controlled money printing, and wealth redistribution. The U.S. is executing one of those 4, just one. That asymmetry is what institutional money is responding to. Here is where 3 data points connect. Data point 1. Central banks bought 1,313 tons of gold in a single quarter in 2025. Not because gold is cheap, because they understand which exit has been chosen, and they are positioning before the public processes what is happening. Data point 2. The Federal Reserve maintains a $6.5 trillion balance sheet and calls it a technical maneuver. It is not technical. It is the operational infrastructure of option 3, the machinery of controlled debasement, running continuously and quietly. Data point 3. The U.S. ran a $1.83 trillion deficit while paying $1.1 trillion in interest. The deficit is not funding investment. It is funding interest on previous deficits, borrowing to pay for prior borrowing. That is Dalio's debt-death spiral as a current accounting reality. Connect those 3 points and the picture is exact. The decision has been made. The exit is debasement. The institutions that understand this have repositioned. Dalio's all-weather framework identifies this as the stage where long-term bonds underperform, equities deliver real returns below inflation, and hard assets absorb capital fleeing paper, confirmed by Q1 2026 flow data. What Dalio's framework tells us about this exact moment. The window between institutional repositioning and public awareness is historically narrow, measured in months. In debt cycle transitions of this magnitude, that window closes before most people recognize it has opened. You are not being told this publicly. Drop a comment below. Do you think this ends in a beautiful deleveraging or something much harder? I want to know what you think. And if this kind of analysis is what you are looking for, subscribe to the Reid Briefing. This is exactly what we do here every week. But the other side tells a different story, and I want to give it a fair hearing before I tell you why I think it breaks down. The optimistic case is built on real data and 3 structural arguments that serious economists take seriously. I take all 3 seriously. To understand what the data is actually showing, you need to understand why the optimistic case is compelling, not simply dismiss it. Argument 1. The dollar has no viable replacement. The euro is fragmented across 17 sovereign fiscal authorities with no unified debt instrument. The yuan is capital controlled, not freely convertible, and backed by an economy managing its own severe real estate debt crisis. Gold cannot function as a currency for international trade settlement at scale. Bitcoin is too volatile for central bank reserve allocation. When global instability rises, and it has risen consistently since 2020, capital moves into dollars, not out of them. The worse the world gets, the stronger the dollar tends to become. The dollar's reserve status is not a legacy. It is active, ongoing structural demand produced by the absence of a credible alternative. Argument 2. The United States has survived this before. After World War II, debt-to-GDP reached 120%, above Rogoff's 90% threshold. The U.S. did not collapse. It grew out of the debt burden. GDP expanded at 4 to 5% annually through the 1950s and into the 1960s. The debt became manageable through sustained expansion, not through austerity or default. Argument 3. The AI productivity revolution has no historical parallel. If artificial intelligence delivers even a fraction of the productivity gains serious economists project, McKinsey estimates a $15 trillion boost to global GDP by 2030. The growth-to-debt ratio shifts in ways no debt cycle model from the past 300 years anticipated. Transformative technology at this scale is a genuine wildcard. I have given these arguments the weight they deserve. Here is the flaw, not in any single argument, but in the shared assumption underneath all three. Every optimistic scenario requires the United States to grow faster than its debt service costs are compounding. Right now, Treasury debt service is expanding at approximately 15 to 20% per year as debt rolls over at elevated interest rates. For nominal growth to outpace that trajectory, the U.S. would need sustained nominal GDP expansion of 5 to 7% annually. And sustaining that growth requires inflation of approximately 4 to 5% over a decade. Think about that for a second. The optimistic scenario, the one where America grows its way out of the debt problem, requires exactly the same sustained inflation that the pessimistic scenario predicts as the consequence of debasement. The destination is identical. Only the label applied to the journey changes. The optimistic case does not avoid the purchasing power erosion. It just describes the erosion differently. And that gap between what the optimistic case requires to be true and what the data actually shows is exactly why the next section matters. So let us stop talking about empires and debt cycles for a moment and talk about what this means for your money specifically. Start with your savings. If you have money in a bank account right now, savings, money market, checking, you are already experiencing the first consequence of the debt cycle stage we have been describing. Not in theory, in your account balance. In the 1970s, stagflation, the closest historical parallel to 2026 in Dalio's framework, the purchasing power of a $50,000 savings account dropped by 40% in real terms over 7 years. Not because the number changed, because everything it could buy cost 40% more. Since January 2020, cumulative U.S. inflation has already reached approximately 23%. A savings account holding $50,000 in 2020 and still showing $50,000 today has lost roughly $11,500 without a single withdrawal. If the current cycle tracks the same arc, that account loses an additional 15 to 20% in real value over the next 5 years. Now look at retirement accounts. Goldman Sachs projects 3% annual real returns from U.S. equities over the next decade. Their central expectation, not a crash scenario. In the 1970 cycle, a $200,000 retirement portfolio delivered approximately $240,000 in nominal terms a decade later. Adjusted for inflation, it was worth less than when it started. Nominal gain, real loss. That is the hallmark of this debt cycle stage. Now look at mortgages. The 30-year fixed rate currently sits near 6.75%. In 1981, during the last major debt cycle correction, it reached 18%. The mechanism that drove rates there was identical to what is active now, a government that has lost pricing control over its own debt. When foreign buyers reduce treasury demand, and China and Japan are both reducing, yields must rise to attract replacement buyers. Your mortgage rate is a downstream consequence of sovereign debt dynamics, not a standalone market event. Now look at food costs. Agricultural commodities are priced globally in dollars. When the dollar loses purchasing power through sustained debasement, option 3 from section 5, commodity prices rise in dollar terms even when supply is unchanged. The 23% increase in U.S. food prices since 2020 is not primarily a supply chain story. It is a currency story, and that story is not finished yet. Here is what Dalio's all-weather framework identifies as having historically preserved value in this specific debt cycle environment: inflation-linked instruments, commodity exposure, and assets that cannot be printed. Not as investment advice, as a 300-year pattern confirmed across every debt cycle of this magnitude in the historical record. If you have been watching this channel for a while, you know I do not ask for likes unless the content has earned it. If this section earned it, give it a like. And if you are not already subscribed to the Reid Briefing, this is exactly the analysis we publish every week. Subscribe now, because the next section is where all of this lands. So here is where this goes. And I am going to be direct because that is the point of this channel. Short term, the next 30 to 60 days. Watch two indicators specifically. First, Treasury auction bid-to-cover ratios. When that number falls below 2.0 on a 10-year auction, it signals that foreign and institutional buyers are pricing in reserve currency risk explicitly. Second, the dollar index. If DXY breaks and holds below 98, the reserve currency narrative becomes visible to mainstream financial media. Those two signals together are the confirmation that the midterm scenario has already begun accelerating. Midterm, 6 to 18 months. Two paths, named specifically because naming them makes them trackable. Path 1, the slow burn. The Federal Reserve maintains its balance sheet near $6.5 trillion. Consumer price inflation stays elevated between 3.5 and 5% annually, high enough to erode purchasing power steadily, low enough to avoid political crisis. The dollar weakens gradually, no single crash event, no headline moment. Just the debt cycle completing its arc, year by year, account balance by account balance. This path requires no political courage, which is why institutional incentives point toward it. Path 2, the Volcker correction. Political pressure or a failed treasury auction forces a dramatic policy reversal, sharply higher rates, a contracting economy, rising unemployment, significant asset price corrections. The debt dynamics reset. The purchasing power floor stabilizes. This path has historically worked. It also required, in 1979 to 1982, a Federal Reserve chair willing to be despised for 3 years to execute. Based on every historical parallel in the last 300 years of debt cycle data, the more probable outcome is the slow burn. Not because it is the better outcome, because it requires no political courage and no single decision maker absorbs concentrated blame. The cost distributes invisibly across millions of savings accounts and retirement portfolios over a decade, making it politically survivable and financially devastating simultaneously. I want to be honest with you about something. The Volcker correction is possible. It happened once before, under conditions that were arguably less structurally entrenched than today. I am not here to tell you collapse is certain. I am here to tell you what the pattern shows, and what the current data confirms about which path we are already on. Here is the question I am leaving open, the question that drives the next video. If the slow burn is the more probable path, the critical variable is not whether it happens, it is how fast it happens. There is one specific indicator, updated monthly, that tells you the pace of the burn in real time. We are going to cover that next. If you want to be here for that analysis, subscribe to the Reid briefing and turn on notifications now. Because when this moves, it will move fast. The debt cycle does not care about politics. It does not care about optimism. It only cares about the math. And right now, the math is speaking.